I'm on the record that this will end up as a failure to deliver, and I believe that will begin, or that will happen first in silver. It'll be followed by gold probably within 24 hours. You mentioned squeeze. Squeeze is that looks toward price. Have we been in a squeeze? Yeah, absolutely. The price is going higher, but the danger is that there's more delivery demands than there are ounces in inventory to deliver. And that failure to deliver, COMEX will issue force majeure. They'll pay people in cash. That way they can say, no, we didn't default, but make no mistake, it is a default.
Michael Hartnett, the chief investment officer for Bank of America, or come out and say, sell. You should have 25% stock, 25% bond, 25% short-term treasury, 25% precious metals. What? Bank of America say 20, and now they're saying silver could go to 309.
Tightening physical supply is rapidly turning the silver rally into a structural crisis rather than a normal bull move. What's driving prices now isn't speculation alone, but growing stress inside the delivery system itself. Bill Holter and Andy Schectman warn that silver is on track to experience a failure to deliver, with demand for physical ounces exceeding what exchanges can realistically supply. In that scenario, paper contracts may be settled in cash under force majeure, which avoids the word default, but confirms it in practice. Silver is expected to crack first, with gold potentially following within hours. Even establishment voices are shifting. Bank of America's chief investment officer has publicly suggested large allocations to precious metals and floated upside scenarios that include silver reaching $309 per ounce. That kind of projection reflects deep concern over inventory shortages, broken price discovery, and collapsing confidence in paper markets. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Everybody's worried about price. Forget about price. The bottom line is, do you own it or do you not? How many ounces do you have? You're going to count your net worth in the future in ounces, not dollars, not yen, not euros. You're going to count your net worth in ounces. So price does not matter, because silver is going to go through a failure to deliver. And when that happens, you either own silver and have it, or you don't. You're either in or you're out. And if you're out, you'll never be able to get back in. You'll never be able to get in. There won't be physical metal for you to buy with fiat. Fiat is not going to be accepted for physical metal. So don't worry about price. Just get capital out of the system into metal. Metal can't bankrupt. The system is bankrupting. I would ask you to go back and remember what happened in April of 2023 when those 3 banks in California went down on a Thursday or Friday. I was on a short trip. Turned out really not to be a trip, because the phone started blowing up. People were scrambling to buy metal. And by Monday morning, no dealers had any metal left in stock. And I mean, we were taking orders with the promise to deliver in 6 weeks. So what I'm getting at is, this can happen very quickly. And I'm on the record that this will end up as a failure to deliver. And I believe that will begin, or that will happen first in silver. It'll be followed by gold probably within 24 hours. You mentioned squeeze. Squeeze is that looks toward price. So have we been in a squeeze? Yeah, absolutely. The price is going higher. But the danger is that there's more delivery demands than there are ounces in inventory to deliver. And that failure to deliver, COMEX will issue force majeure. They'll pay people in cash. That way they can say, no, we didn't default, but make no mistake, it is a default. If you bought a silver contract with the expectation that you could stand for delivery, get the metal, and you don't get the metal, that's a default. From a technical standpoint, they can legally say it's not a default, but in the real world.
Not only do you have the arbitrage in China, where they're posting a constant $5-6 spread between New York and China, where they are incentivizing the traders, the big traders, to buy paper in New York and sell physical in China to, in essence, capture that arbitrage. And what we're doing is we're playing right into their hands, and that silver won't come back. So you have that. You have so many things where you have a global rush. Now, so you have at the end of 23, the European Union says silver is a critical mineral. In November of last year, China issues a memo saying, yeah, we're going to prioritize domestic ownership of silver for our own people. Then we come out and say silver is a strategic metal. And then they say, well, we're going to limit exports. Well, this is not about two brothers like the Hunts trying to corner a market. And the interesting thing is, it's the same situation. The Hunt brothers noticed that there were more paper contracts than there were bars behind it. So let's buy the paper, stand for delivery. Well, and the exchange does what the exchange always does. They change the rules or modify the rules, kind of like they're doing here and going right after the longs. Well, that ain't what this is about anymore. This is about some of the biggest, most well-informed money in the world that is making a rush to accumulate a metal that is finally being admitted as strategic, not just industrial, and arguably worth more than the dollars used to purchase it. And what started out very quietly is now beginning to take notice. And the funny thing about this, Ivan, with all of the performance of silver blowing everything away, where the hell is the mainstream media? Where is the integrity of anyone in the mainstream? Not only talking about what silver has done, but how about the fact that we are seeing billions upon billions upon billions upon billions upon billions coming into COMEX every single month? And where the hell are these idiots like Jim Cramer or any of them on CNBC or Fox saying, something's going on COMEX, because whoever is doing this to the tune of billions of dollars, well, that's not your little trader. These are the most sophisticated people in the world who don't do this for the heck of it, right? I'd like to be a little bit more profane, but I won't, because I just want the point to get across here that that's all you need to know. I mean, before that, all you need to know is, why did 8 Western banks hold the largest concentrated short position of any commodity ever traded on the 1,000+ commodities on COMEX? Why in silver? Why? Right. And that has to do perhaps with the military industrial complex. And that's another discussion for another time. But when you see the biggest traders in the world doing these things, seeing what they do and getting zero attention by the mainstream, you should be very keenly interested in exactly what they're doing, because it's front running, and either you see it and choose to trust it or you don't. And I think that's exactly what is happening right now. I think it tells you that we have not seen the end of this bull market for a long time with the amount of money coming in physical metal into the COMEX.
This phase of the silver bull market is no longer about price charts or short-term volatility, but about ownership and availability. What matters now is how many ounces investors actually control, as wealth increasingly shifts from fiat currencies into tangible metal. Growing delivery stress is exposing a system in which paper claims far exceed actual inventory, raising the risk of force majeure settlements paid in cash rather than metal. When that line is crossed, price discovery breaks, and physical silver effectively disappears from open markets. Recent history shows how fast this can happen, with banking shocks triggering overnight shortages and months-long delivery delays. At the same time, global policy signals are tightening supply, as silver is increasingly classified as a strategic and critical metal, with export controls and domestic hoarding accelerating. The surge of institutional capital into physical channels confirms this is not speculative noise, but a structural shift still unfolding. Let's get back to the interview.
The massive purchasing of gold and silver by the central banks. India, huge silver consumer, but deeper than that, Saudi Arabia taking big interest in silver. China, the number 2 producer in the world, flying all over the world to, in particular, Peru and Mexico, buying pre-refined silver in doré and concentrate, paying double what the West will, shipping it back to China to refine it. The central banks buying tremendous amounts of gold and silver, but removing them not only from the exchanges, removing counterparty risk, standing for delivery, but even taking their metal back from the New York Fed, which always gave access to the COMEX, and from the Bank of England, which gave access to the LBMA, an overriding theme of accumulation and repatriation and removal of counterparty risk by the most well-funded, but more importantly, well-informed traders in the world. Now, if we take that a step further, whoever got to President Trump and said, dude, if we don't bring this back, if we don't get in this game, we're in big trouble. And we've seen that now for 14, 15 straight months. We've seen massive deliveries. In December, there was 64.7 1.73 million ounces of silver issued and stopped, which basically means delivered. Doesn't mean left the facility. A good amount did leave the facility, but what it did mean was that there are huge amounts of interest that are bringing in the real metal instead of the continuation of the paper promises. That was the largest ever 1 month delivery of metal in silver into COMEX. And then we look at it here just in the first 3 days of the January contract, first or second, third, and fourth, we saw, what was the number here? First 3 days was a huge amount. Sorry, I don't have it at the tip of my fingers, but I believe it was somewhere in the neighborhood of, by the way, 62,875, December delivery, 62,875,000 ounces. Now, in the first few days of the January contract, we see, where the hell did that go? Somewhere in the neighborhood of 18 million ounces of silver stood
just in the first 3 days.
In the first 3 days. And so, the biggest money in the world and somewhere in the neighborhood of about 600,000 ounces of gold in the first 3 days. These are billions of dollars of both gold and silver standing for delivery in 3 days, but repetitively every single month since a year ago, November, these people know what's coming and they're front running the public, and they're standing for delivery in massive amounts when it used to be exchanging of warrants, not as much metal moving. There's a good deal moving now. And that, to me, you're talking the most well-informed traders in the world see something that the public doesn't.
And the ratios come down, but still at 55, 56 to 1. I've said that people should be at least 70-30 in favor of silver with an eye toward swapping silver at a later date for gold. And I told people for the last 5+ years that if you want to be 100% silver, I don't have a problem with that. But when all is said and done, you want to have more gold than silver. I mean, optimally, you want 60-70% plus in gold versus silver during normal times, but we've not had normal times or a normal gold to silver ratio, probably for 30 years. So silver has been the target. Silver is where I believe the failure to deliver will happen. And the bottom line is, once it fails to deliver, you're either in or you're out. You're not going to be able to alter your position. You won't be able to buy gold. You won't be able to buy silver. If you don't have it, you're locked out. The real economy is upside down and basically, I don't want to say closed, but severely hampered. The demand for platinum is going to drop. Platinum nor palladium are considered precious metals. They're not considered money. Gold and silver are money. The reason you want gold and silver is because they are monies that cannot default. And the system is not tenable, and we will go through an insolvency default. The system itself is in the process of defaulting. So you want your capital outside of that system and in something that cannot default, and that something should be money, gold and silver. There is a price for metals. Look at the cash market. Look at the Shanghai market. Look at the cash exchanges versus New York or London. Those two are paper exchanges. And you have a bifurcation between the paper market and the cash market. The answer to your question is, when silver fails to deliver, gold will be right behind it. And we're talking about derivatives now. That is well over a $2 quadrillion market when all the assets on the planet of Earth are 300, 400 trillion. So there's way more bets than there are assets. That will collapse everything. It will collapse trust. Which thus collapses confidence. Everything runs on confidence. And guess what? The money you have in your bank, the money you have in your wallet, it's confidence money. It's been a con game. All I know is we're in a structural deficit. It looks like there's going to be a failure to deliver on paper markets. And when that happens, it's game over. If anybody gives you time and or price, they're full of shit because nobody knows. And just understand that when this thing melts, when the whole system melts down, all the leverage is going to break. I mean, stock markets, bond markets, real estate markets, they're all held up with leverage. But guess what? That same leverage was used to suppress the price of gold and silver. So the way to close the gold and silver positions for these institutions, they got to buy.
This moment in the precious metals cycle is being defined by scale. speed, and intent. Central banks and sovereign buyers are no longer trading paper claims. They are demanding physical gold and silver, repatriating metal, and removing counterparty risk from the system. Record deliveries on COMEX, including tens of millions of ounces of silver in single months, signal that the most informed capital is front-running a structural breakdown in paper markets. The widening gap between cash prices in Asia and paper prices in New York and London reinforces the view that this is about real metal, not leverage. Silver remains the focal point. With an abnormal gold-to-silver ratio, once delivery stress turns into outright failure, access disappears, and positions cannot be adjusted. In that environment, ownership matters more than price, and issues of preparation more than timing. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.